Hey, everybody, welcome back to today's Market Explained, a FourStar media event. And I'm your host, Brian Kasal. I'm here with my co-host, Chris Reardon. Chris, welcome again to the podcast.
Thanks, Brian. Glad to be here and glad to talk a little bit about the market.
And today we're going to do a little bit of development on the economy and what's going on, and we'll kind of walk through all that. Again, I'm Brian Kasal, your founder. I'm Eagle Scout, National Boy Scout Foundation trustee, advisor to CEOs, and chief dad to Quinn and Evan, and husband to the amazing Trippy. Chris Reardon is our director of development, and he's master of all things portfolio, trading, reports. Still loves his Cleveland Indians, and he's got a new burgeoning family of three very young children. So Chris is my co-host. So that's players for today. Chris, welcome. Tell me what is going on with the different asset classes in the market. Are we seeing any trend changes in the six major asset classes?
Yeah, we're starting to see a little bit. We're starting to see some movement. We haven't seen any major changes yet, but we're starting to see potentially some changes coming down the line. We still have number one being commodities, so it still is holding that number one position. It's at 246 tally points, so it's lost 9 points since the last podcast. So we did see commodities start to pull back. Some of that's due to oil weakness and other commodities that have, in the short term, last couple of weeks, that have kind of pulled back a little. Number two is international equities, so it's still maintained its number two position. It's at 243, and it gained 2 points from the last podcast. Number three is domestic equities. It's at 241, and it gained 4 points from the last podcast. So really, and we've talked about this before, but it's been really a three-horse race kind of in that those top three positions have been very, very close. You've seen them move back and forth. And we're seeing them once again kind of coalesce. The commodities is pulling back. Both domestic and international equities are both gaining. So they're both coming together right around that 244, 245 mark. So we could see any day now really a switch within the leading asset class. They're really, for all intents and purposes, tied, really, as we would look at it. Number four is cash still. It gained 4 points from the last podcast, at 168. Number five is currencies. It gained 2 points from the last podcast at 106. And still in last is fixed income. It gained 2 points from the last podcast, and it's at 81. So not a whole lot of change, but as I kind of stated in the beginning, we are starting to see those top three really kind of come together. Again, the points kind of coalesce. So we could see some changes really any day now or any week.
Excellent. Well, we'll see. So not really any major change in this last reading. Commodities had a big rally. Now they pulled back, but very incremental changes. But Chris, we're seeing a bit of a rally in the financial markets, though, even though we haven't seen much change in the asset classes and the relative strength of them. But it's still, commodities are still in charge in number one, but not waning a little bit, right?
Yeah. I mean, we've seen a rally the last week or two in the financial markets. Some people might expect domestic equities to be higher on that list or have gained a little bit more. But I think one thing that's important to consider is commodities have been strong, and even though they have weakened, most of that being attributed to oil. You still have precious metals, you still have agricultural. So there are other commodities that have been more stable, and in some cases gaining momentum.
Right.
What we've seen this recent rally in the U.S. markets is mostly off the expectation that the Fed is going to kind of relent with these rate hikes and eventually lower rates. And with that, we get the commodity gold or precious metals usually moving upwards as the dollar depreciates. So it's not necessarily kind of a one for one, but there's a lot of factors that go into it for sure.
Yes. Well, okay. So it's an interesting environment we're in. We're kind of straddling, looks like it's becoming an economic downturn. And then we had a big pullback in the markets. Now, since November 1st, NASDAQ is up 8%. Those things fly around constantly. S&P is up about 3%. However, many of the strategists that track things long term say, well, this is just a rally in a kind of a bear phase, and they think we're going to go lower. B of A's Mike Hartnett and then Morgan Stanley's Mike Wilson both feel that way, and they've been pretty accurate strategists. In our work, we had gone all the way from fully invested down to position 3. Position 4 is where we would be maximum cash. And Chris, by way of review with everyone, we've only been maximum cash 7 times in 29 years. So it doesn't happen that often. So we started catching a rally, and now we're moving back to position number 2. So we're putting a little bit more back in case this is a real rally. We don't know. If it breaks down, we can get back out, but we're always kind of moving incrementally one way or the other to make sure that we manage the risk that's out there in the portfolios, and that's where we are right now. There's been a big pullback in Bitcoin recently. I did a new high, but then it took a sharp pullback in the markets. And then, Chris, you were talking about some of the other economic factors that really are affecting and could affect the economy. The one was loan payments.
Yeah, I mean, I think one thing a lot of people are looking at right now is, the big move we saw in the last, really that powered the last week and a half of movement in the market was mostly due to the CPI print number. I guess we'll touch on that first. That came in lower than expectations at 3.2% year over year for October. One of the biggest components of that was gasoline that did fall. So we're starting to see CPI or inflation, which is a good proxy for inflation, come down. And so we're seeing the markets move upwards off of that. And the hope or expectation is that the Fed has defeated inflation, which, there's varying thoughts on that, but that they've defeated inflation and that they will now relent and then eventually be able to lower rates, which will then, power the markets higher even more. So we're seeing that. But, against that headwind, if you will, we're seeing student loan payments that have now resumed. They started in October. So what's going to be really important to look at is the November, December kind of consumer consumption and spending numbers. The average loan payment, I think, is somewhere around $800 a month. So when you factor in someone who had now $800 of money that they could spend and allocate how they like, whether they want to take a trip or go to Target and buy something or whatever, now that is going towards the loan payment, which is good. It's reducing debt. It's great. But overall, it's just kind of going into the government owns most of the debt, going into the government, kind of a black hole, if you will, from that end. So it'll be really interesting to see how that plays out. Will that have a huge impact? Remains to be seen, but there's a lot kind of going on in that. And then the last thing, or the couple other things I'll highlight real quick is the jobs market, which has been very, very strong. We're starting to see some inklings of it potentially rolling over. And I think the first sign of it is in the seasonal period. Obviously, we're in November now. We're entering the holiday season. A lot of companies hire extra help because of the rush with the stores and all that. The number of seasonal positions publicly advertised this year for this holiday rush is down as much as 40% from 2021. So we're seeing a lot of companies, hiring less workers. The XPO, which is a logistics company, trucking, they said they expect to just maintain. And then the U.S. Postal Service said that they would hire 1/3 of the seasonal workers they did last year. So they're going to hire only a third of what they did last year. And Macy's announced they will be seeking 3,000 fewer seasonal workers this year. So, that's, I think, a good glimpse potentially into kind of a weakening jobs market potentially. I think it will be interesting because the jobs market, even as it weakens, it will not be like people kind of go back to 2008, 2009, the last big crash in their mind, or recession. And it won't be, I don't think it'll be like that just due to demographic changes here. You have a lot of baby boomers retiring. You have a different workforce than you had back then. But it certainly is going to impact the markets as everything kind of comes together. And then the last thing I'll add is Home Depot came in with same store sales that fell 3.1%. And this could be an early sign of that consumer spending less, as we were talking about before. But more importantly, the company logged 2.4% fewer transactions, so less people in average shopping there, and the average size of those transactions, as far as ticket size, was lower as well. So, we're obviously looking at a lot of data and just trying to figure out, are there some early warning signs? I think November and December are going to be very, very important. They usually are because the holidays, there's usually a lot of spending. I think this year especially, it's going to be very important to see the impact of the loan payments and B, kind of how's the job market and how's the spending holding up.
Mhm. So, Chris, talking about CPI numbers in the economy, what does that look like?
As far as the economy overall, I think that Q4 will be interesting to kind of see. I think the overall economy right now has held up. It's remained relatively strong. And I think relative to other countries, the European Union now has had more of an issue with inflation, and they are certainly moving, if not already, in a recessionary kind of spiral. And then the recent news out of China came in, and their situation just seems to be getting more and more dire. Their exports fell 6.4% in October year over year, which was much greater than economists' expectations. That they were expecting 3.5% decline, and they got a 6.4% decline. So obviously that's very large, and that's the sixth straight month of declines for Chinese exports. And I'd say more importantly, the number posted for September was 6.2%, and October was the 6.4%. So we are seeing somewhat of an acceleration there. And there's a lot of things that factor into this. Obviously, we have the tensions in the Middle East. You have the Ukraine-Russia war going on. So there's a lot of things that are impacting consumption around the world, which is impacting the exports because China is obviously a main builder and exporter for the world. So there's a lot that feeds into there, but it's just more and more bad news coming out of China. We're seeing kind of a worse and worse picture. So it'll be really interesting to see how they get out of that. I think one thing to their credit that I will say is, I think going back to like 2015, 2016, there was similar expectations that we're going to see the Chinese bubble pop, if you will, and it didn't happen. So the Chinese economy is very large. It's they're government controlled, so they can pump more and more money into it. So I would doubt that this is kind of the end of it, but it'll be interesting. There's definitely a lot of impacts going on around the world. And what does that do for the U.S. economy? I think mainly what it does is it helps the U.S. economy. We're seeing the U.S. economy the best looking economy in the world right now, and that's certainly helping the stock market.
Yes. Well, very interesting. Pessimism from the retailers and slowing spending is causing people to wonder what's going to happen. But, the markets seem to know all that already, and we're having a little bit of a rally. So normally the markets are a discounting mechanism long in advance of issues and problems. And then the realization of it comes later, but very often the markets are traveling upward into the bad numbers because they already anticipated them, right? And so the market's usually way ahead of where we are in the economy. It could be playing out the same way here again. We had a market low in October of 22 in a very, very bad year. Then 2022 was the worst investing year of my career, and certainly many folks' careers, with both the bond market and stock market down for the first time together in 1 year, in a very, very rough way. So we're still about 10% above the October 22 lows and now going higher. So could it be that we're establishing a higher low and then we'll go to higher highs, and that's the beginning of a bull market? And that means that the October 22 low would have been the low of the market. But you often don't know that the low is in for many, many months, or in this case, it's almost a year, if that would be the case. However, if the economy really turns down dramatically from here, well, then we'll probably see the stock markets and all the risk assets get repriced lower. and then we probably would break the October of 22 lows, Chris. So while we see these numbers teetering around and we can't really quite figure out whether we're moving forward or backward, that's kind of what it feels like at this point. We'll just keep watching the market. Market seems to want to go higher, and we went down to position number 3 from position number 1, not quite all the way to position 4, which should be maximum cash. But now our work is saying to get more invested. So in case it is a real rally and the markets have bottomed and we're going to start going up from here, we're going to be defensive by putting more money in. It's defensive against underperforming in a rising market. So we're probably going to go to position 2. And then that means we'll be doing some buying in the next day or two. But then we'll see if it turns around, we'll go back down. We never really want down markets. No one wants down markets. We just do the protection in case we do get down markets. But we really hope that prediction or trend ends up being wrong, because we want the market to go up. No one wants the market to go down. But the reality is it does sometimes, and we have to protect ourselves when things get really bad. So, Chris, there's a lot of things going on out there, and what we see out there as well. We're seeing some other interesting tidbits, right, about the movies and the things.
Yep. Yeah. So Disney's newest movie in the Marvel Cinematic Universe, which is, it's been a huge moneymaker for them previously. It's called The Marvels. It came out with a thud on its opening weekend. It sold 47 million in tickets in North America, which is the weakest of any debut. And it's concerning. I know a lot of people who like Disney or their stock in general. Concerning from a stock standpoint, because I think the last 3 or 4 Marvel movies have been way underperformed what the expectation was. And when this is such a large franchise for them, for the company as a whole, that's going to have a huge impact on the bottom line. So we continue to see this trend. And obviously Disney brought back in Bob Iger to kind of help right the ship. And I know he's probably doing as much as he can to try to get things moving in the right direction there. So we're still seeing some trouble out of Disney. ExxonMobil came out and said that they're starting to drill for lithium in Arkansas with the aim to become a major battery supplier for cars by 2030. So that's great news. You've talked at length on this podcast about how certain lithium mines have had regulatory hurdles they couldn't overcome, and certain objections from that front. So it's good to see that some lithium is being mined here in the U.S. And then on the kind of automotive labor front, Jeep maker Stellantis is preparing to offer buyouts to roughly 6,400 white-collar non-union employees. And this comes as the negotiations and finalization of a contract with their union workers, mostly production line workers, comes to kind of the end. And the expectation there that we're going to see a 25% major wage gains there. So Stellantis is trying to protect its bottom line and trim some of the kind of white-collar office workers in the U.S. here. So it's interesting to see. And then Hyundai Motor said it's going to raise the hourly wages for certain of its U.S. employees on production lines the next year. So it's starting in 2024 with the goal of the wage increases being a 25% wage increase by 2028. So it's really interesting. Obviously, when we have these negotiations for the unions, once we get that kind of final number, the market changes, right? So the market for a now kind of a production line worker, it forces a lot of the other companies to go and have to kind of pay those wages as well. So we're starting to see some of that movement. And then the last thing I'll highlight, kind of big news this week, is President Biden met with Chinese President Xi Jinping. It was Wednesday of this week. I think it was Wednesday, November 15th, is when they first met. So they're hoping to kind of continue normalization or, discuss normalization of relations between the two countries. And hopefully one of the big items, I think, is the military to military contacts, which discontinued, I want to say 2 years ago, after Nancy Pelosi visited Taiwan they discontinued military communications, which is a big deal because if you don't have aircraft and other ships talking to each other, makes the probability of an incident happening much greater. So hopefully we see that normalization. I think overall the meeting went, there were definitely ups and downs with the meeting. So we'll kind of have to wait and see what the fallout is, I think, from it.
Yeah, exactly. Well, it was a very contentious meeting. Even in the meeting, the president said that President Xi was a dictator, and that Secretary of State Blinken winced in the crowd as he said that. So, I'm not sure we ended up with better relations with China or not. At least they were in the same room. But apparently, President Xi seemed to like the California governor who cleaned up his state for his early San Francisco for his arrival. So we only talk about these political issues because they do affect the economy. The economy in China, Chris, is slowing, and many people are very scared of dealing with China because of their desire. They're allowing fentanyl to come into America, and they're letting it happen for sure. They're also trying to damage America in so many ways. That spy balloon incident that happened last year also was a big, sore spot with many Americans. So China is very aggressive, and it's affecting commerce. They're moving a lot of the manufacturing either onshoring back to America or to other places in Asia, but away from China. And many business people don't want to go back to China. So it does affect the economy a lot when political leaders are warring and not getting along. And then we have a second war. Now there's talk there might be a third war with Taiwan, with China would go into Taiwan. So we've got one war in the Ukraine, another war in Israel with Hamas against the world, and Israel coming back at them. So these things create complications for the economy, and a lot of disruption for sure. So we'll see how it all plays out. We certainly hope the world gets more into a peace mode, and we reject all of these negative situations. But only time will tell, Chris, right?
Yeah, I mean, I think no one wants war or escalation of tension. So we'll just have to kind of wait and see. Obviously, the last couple of years we've seen escalations. I think that we haven't seen in the last 20 years. War in Europe, and obviously now heightened tensions in the Middle East. So who knows? There's always this looming potential that China will invade Taiwan. Obviously, that is it's a stated goal of President Xi Jinping, is to bring Taiwan under the Chinese government. So there's always going to be that risk. Hopefully they kind of balk at that and then don't go through with it. But it's something we'll have to remain to be seen. It is promising, as I said before, that we are having discussions and talks with China. I don't know if they'll ever become friendly, but at least if we're having general discussions and they both want the same thing, which is peace and for both countries to prosper. Hopefully that's the case.
Well, whenever America is weak, bad things happen in the world. And at any given point in time, there's one country that's the leader of the world. For a couple hundred years, it was the British Empire. And before that, Argentina was one of the strongest countries, believe it or not, in the world. And now we're clearly been the leading country, but we're showing weakness. And whenever we show weakness, and we're not resolute in all the things that we're trying to accomplish, people step into the breach and try to do things. And all the old wars start up again, like the Hamas war and Russia going into Ukraine. These things happen when America projects weakness. So then that affects the economy, it affects the world, it affects everyone's lives. And so we hope things get better for sure. Chris, one thing you mentioned about earlier, and then I wanted to cover a little bit about is slowing in the auto industry, but yet wage increases, and they're offering retirement packages. So a lot of changes in the auto industry. And one of the big trends is electric vehicles. So our government has gone all in for electric vehicles. They're offering big subsidies, which rankle a lot of people because these cars are so expensive. It turns out to be subsidies for rich people because the average person is not buying an $80,000 car. And so you've got electric vehicles that we're pushing really, really hard for the purpose of trying to clean up the environment. But we're now, of course, seeing a slowdown in electric vehicles, all the major car companies have said that they're slowing their production of electric vehicles. Battery technology is not quite there. And we do a lot of early stage investing, and we met with the leader of one of the top battery technology companies that is actually doing some angel investing and created some entities that he needs funding for. So we're considering investing, but yet if growth is slowing in the electric vehicle market, the question is, will that investment work, right? And is this really a growth market now, or did we go too far with it? What happens if the subsidies were to go away? Would the market still be normal? We could see an administration that comes in and gets rid of the subsidies because they don't want to keep offering subsidies to wealthy investors to buy a big Tesla. So we'll see what happens there. But there's also the burgeoning discussion about hydrogen power, and they've now found a perpetual motion hydrogen power program that works. They need to find a way to turn that into something that could power a car or a machine or something else. So hydrogen power could come in and knock electric batteries off their market. Plus, a lot of folks want to go back to fossil fuel vehicles, and there's plenty of oil in the world. Our government's trying to tamp down oil drilling, but there's oil all over the world. And, maybe it's not a forever supply, but there's visibly as much as 100 years left of oil at the consumption rate of the world. And so, these are big issues to discuss. Electric vehicles are slowing. So we'll see. The other big trend that's going on is artificial intelligence. And if you check the blog posts on the FourStar, the leadership matrix, we put a piece out about that because this year, this year, the artificial intelligence stocks are really the only stocks that are up. So the S&P 500 has 7 recognizable names that are artificial intelligence related: Microsoft, Google, NVIDIA, and a few others. And those stocks are up big, really big. And the NASDAQ index is up as a result of that. And the S&P is up as a result of that. But until recently, the average stock in the S&P was down. 493, the S&P 493 was flat. But the index was up 10% because of those 7 stocks. So have we gone too far with AI? Anybody who was around in the late 90s, Chris, remembers the tech boom where stocks were going up to astronomical multiples in the tech area. Companies are coming public with no earnings, but companies are coming public with no revenue. It was a madness time in the technology world. And of course, it ended all quite badly a couple of years after that. So are we overdoing the artificial intelligence world? Are we overpricing these stocks? It's possible. Usually when everyone is dancing to one tune and everyone has to get in, I saw a couple articles or a couple ads on TV today about pick your best artificial intelligence stock. So they're pushing it. Everybody's involved. Whenever it gets that way, usually things are getting overheated, right?
Mm-hmm. No, yeah, for sure. I mean, yeah, I think that, I don't think there's any doubt that obviously technology in general and artificial intelligence is going to be something of the future. But I think it's important to know, when and where you buy. I think it's important. So like you said, Brian, if everyone's pushing these stocks, it means that these things have already been bid up significantly in kind of a frenzy.
Mm-hmm. Well, and for an investor who is trying to, thinks that beating a benchmark is their normal life, they have to beat the benchmark, and otherwise they just buy an index fund. Well, the only thing that is up that much is those names. So then those indexes are up. So unless you had an index fund, you're probably underperforming because the indexes have such a distorted percentage of those 7 names, a significant amount, in a way that the average investor would never buy. Like the S&P 500 equal weight indexes is only up about 2% now, but the index itself is up about 12%. So the difference is the overweighting in those AI stocks. So the average investor is probably going to underperform the S&P this year, and certainly the Nasdaq was up as much in the mid 30s at one point. So expect underperformance, but I think the more relevant performance for an investor is the actual equal weighted index. That's how people buy stocks. And we're gonna keep some positions of the AI stocks, but not in the outsized proportion. That's too much risk, we think, to take. So we'll participate, but we're not going to overload the portfolios with those names. But eventually there will be a reckoning, and those stocks go down, and we'll sell them when it's time. But we have to be really careful here, because if everybody's moving into one segment of stocks and pulling out of the others, that's about the time that the others are cheap enough to get in, and the AI stocks are too expensive, and then there's a reckoning where those stocks go down. Anybody who remembers the tech crash, the dividend stocks did very, very well relatively during the tech crash. But the 3 previous years when the techs were moving, dividend stocks did terribly. That's kind of the same scenario we have with the S&P 493 and the S&P 7, if you will, those 7 AI stocks. So when you see some of these trends and you see how things move and you see patterns, and that's kind of what we're seeing. So we just suggest caution to everybody who's doing those kind of names, and be careful when we start seeing ads on TV. Then all the newsletter writers start talking about get into AI stocks. They get all excited and they start pumping it up. And that's when things get a little crazy. So we just want to express a little bit of caution there with everyone. So Chris, that's where we are. Not a lot of changes from the previous episode. We're just seeing some details that we just covered with you here today. Anything else you want to offer today, Chris?
No, I mean, I think that about covers. I mean, I think it's not a huge market change from our last podcast, but I mean, I think it's been more of a positive market change, certainly. But it'll be interesting the next time I think we check in. We could be looking at a drastically different market.
Could be. So we're either going to see this trend continue and it's get extended, or we'll see the markets trend back downward. So we'll be reporting on that very soon. We've got a couple of other interview episodes coming out as well, Chris. So we'll be back to you very soon, everybody. Thanks for being with us on today's Market Explained. Today, we're into the 170 episodes now, and things are going really well with our show, and we want to thank everybody for listening. Thanks, and we'll call it there for the day. Goodbye, everybody.